So I actually started taking the money and I put it into a cash flow bank, which is just overfunded cash value insurance and heavily overfunded, so there's lower commission. And, I've had 5.32% on the higher end and,
almost double.
4% on the lower end on my newer policies because of the capitalization period and commissions and all those kind of things. But it doesn't have tax against it. Well, it's accumulating in there. I have ways to access it tax-free. It's not locked away till 59 and a half. And yeah, it's doubled what I'm doing in this savings or money market account.
Yeah.
Money can be complicated. Let a nerd help you. We're here to demystify the complex nature of money by getting you answers from financial nerds and whiz kids. Welcome to Ask the Money Nerds, a weekly segment of the Wealth Labs podcast where we answer your most pressing money questions. The questions are coming in. Where do I save my money? Where do I set savings aside? If I have business profits, what can I possibly do with that? Well, you've asked, I'm going to answer. Chief of Staff Stolba with me today. Amanda Stolba, but I like to call you Stolba. You call me Gunderson all the time.
I know. We just kind of go on a last name basis, don't we?
Yeah. It's more formal. It's like the least formal thing, but it's funny.
It's either Stolba or Iowa.
Yeah,
or there was one other one that's starting to float
Cornfield.
around.
What? No. All right.
Okay. I need to think of a nickname for you.
It's funny because I once called Rich Christensen, who wrote Zigzag Principle, Toes Turn Purple, Bootstrap Business. I called him like a nerd, and so he was like, "You gonna get back at me?" He called me GQ Jesus, and I'm like, I like that a lot.
Yeah.
That's a good nickname. So he's like, oh, he's like, I gotta think of something different. I'm like, no, I like that. That's sticking. No.
And that's actually stuck around for a long time.
I never tell people to call me that because it just feels so outlandish to, I'm not going to compare myself there, but if someone else says it, it's okay.
It's fine.
And he's Mormon, so I feel like it's even more okay.
If it's coming from him, don't stop it.
Yeah.
Bree wrote in with a question.
Okay.
And we're going to talk about business savings. So I think this is a question that's pretty common where I start making money now. What do I do with my extra cash? And
Right.
a lot of people don't want to just put it in a normal savings account, but sometimes that might be a good fit. So Bree's question is, what is the best way to start saving for the future using business profits? I feel there must be other options than just a regular business savings account. So what are your thoughts on this?
Yeah, I got three main thoughts on this. So the first thing is just setting up a separate account in your business account that's not your business checking. This can be a money market or a savings. But what I like to do is, I call that the war chest. It can also be like an opportunity fund. So the war chest is just the more success that you have in your business, the more likely you're going to face a success tax. Everything from embezzlement to a lawsuit to a big tax bill that was unexpected. So having cash set aside for that's really critical. So that's why it's a war chest to be able to handle those things. But it's an opportunity fund because as you grow, you might find there's opportunities that come your way where you can acquire a business that brings new capabilities or expands the offering or makes a good sense to merge. And having that money is super helpful. So the way that I kind of built that for myself was anytime I did something in the business that someone else would get paid for, like if I ended up coaching, which I haven't been a coach for a long time in our business, or if I ended up doing sales, which I haven't been doing sales for a long time, or, I made sure that I was the highest paid or equal to the highest paid in the firm, and I would actually set that aside into this money market account. So it's just a separate money market account, so it couldn't be written a check from the business and just spend it. And over a year, we had a lot of money accumulate. The problem is, as an LLC or S corporation, all those profits are taxed whether you spend them or not. Right?
Yeah.
Unless you have a deduction against it. So it's known as a pass-through entity, comes to your individual tax return. So I was like, okay, well, we were, an LLC. So I'm like, that's not really good. So the second thing is I noticed, I'm like, okay, this isn't earning much interest. Even an internet bank right now is like 2.5% if you have a certain amount of money. That's not even that exciting. It's all taxable. So I actually started taking the money and I put it into a cash flow bank, which is just overfunded cash value insurance and heavily overfunded, so there's lower commission. And, I've had 5.32% on the higher end and,
almost double.
4% on the lower end on my newer policies because of the capitalization period and commissions and all those kind of things. But it doesn't have tax against it. Well, it's accumulating in there. I have ways to access it tax-free. It's not locked away till 59 and a half. And it's doubled what I'm doing in this savings or money market account.
Yeah.
So that would be the second thing. But the third thing would be for more successful businesses that face a myriad of risks. So we talked about the success tax. The more successful you are, the more you might have a target on your back. So As a speaker, we have to have insurance, right? For me as a speaker, a lot of times they want to know about that insurance. Well, I didn't want to really pay for that insurance, so I just created my own insurance company. And we found 11 risks that we could insure that insurance companies were either not insuring or they weren't doing it very efficiently or effectively because it wasn't their main thing that they do. And so we set up what's called a captive insurance agency. And so now I take that money and it goes pre-tax into this captive insurance agency. Now it's not an insurance policy, it's an insurance company that I own to insure my companies, right? So it goes in pre-tax, and if I don't have any claims, it comes out, later on. It has to be at least a year that it sits in there. I've never pulled money out. I've just paid a claim from it. But you pull cash out, capital gains. So it actually, now you're not paying taxes while it accumulates in there. You can only invest it how an insurance company is allowed to invest. So you can't just allocate it to anything. There are restrictions. Mine right now is sitting in a money market, earning very little interest, but it's something I can tap into anytime if there's a good opportunity, because I haven't had a claim for the amount of money that I put in there. So that captive insurance agency, known as an 831B, that would be something to look into. Cashflowbanking.com for a place that you could set up a corporate owned life insurance policy, or even do it personally and set the money in personally if it's an LLC or S corp. Anyway, it's moving there, or just setting up that separate account that you're setting money into. But those are kind of the three main ways. I use the money market for very short-term things, so that if there's ever we don't have as good of a month as expected, or I'm gone to Asia for a month, taking my son on a world adventure to talk to him and bond with him. That could impact our cash flow. So having a little bit of cash there, a lot of cash in the cash value because it's available. I used it to buy a company back in 2014, which was helpful for Wealth Factory to exist. And we hear about Wealth Factory in a lot of these YouTube videos. And then the captive insurance agency that insures Wealth Labs, which we see the sign behind us as we do the Wealth Labs podcast, and I do one-on-one consulting 10 times a year and go out there and speak. And then Ripwater, which is my company where we work together to help financial advisors to improve what they're doing, because of, we're just looking to improve the entire industry because we have a certain philosophy and methodology. So I insure that, and it gets going pre-tax, and that's where I set aside most of the money from the businesses right now. And there's three options for the profits.
Yeah. So if Bree wants to go with option 2 or 3, is that something she would set up one time? Can she put money into it quarterly or monthly?
Yeah, you can put in with cash flow banking and overfunded. You could have a minimum that you pay every month, quarterly, semi-annually, or yearly, but at least yearly. And then you can put extra in. Some companies just have to put a minimum of $100 a year, but then you can go up to what's known as the modified endowment contract, which is how much the government will let you put in without negating the tax benefits. So there is a cap on how much you can put in, but you can always set up a policy on a spouse or on kids or on business partners. So there is other ways to kind of deal with that. But yeah, so there's a lot of flexibility in that. And then with the captive, it's something that you don't have to put the same amount in every year, but it depends on your risk that you're facing and what's known as a feasibility study that tells you how many things you can insure. And it's something that, you're going to be putting in. I put it in monthly. Some people just make annual deposits, and it doesn't have to be perfectly consistent. But if you're not going to do it year in and year out, they're kind of costly to set up, and they're onerous to set up. It takes a little bit of time.
To be committed to it.
So it's not a one-time thing. And it's something that, if you don't have a lot of risks to cover, then you're not going to be able to get what you want out of it. One, because you got to be putting a lot of money into those for them to really make sense because of the startup costs.
Yeah. So you mentioned that there's a cap. So is the cap determined by the feasibility study?
Yep. So there's a cap of like 2.3 million that the government has put out there. When I started learning about them, it was 1.1.
And that's per policy, right?
Yeah, that's really, you're in the gray area a little bit there, but yeah, just think per individual or company overall. And yeah, so it's a pretty high cap for most small businesses. For major corporations, it's pretty small, on the cap. So it's all perspective. And then on insurance, it's just depends on your income and your age. If you're in your 20s, you can get 30 times your income and death benefit, which determines how much you could put in. When you're retired, you might be able to get 1 times your net worth. So there's a real big variance based upon how many years you're working, because what they're looking at is your economic value replaced. Like, what is your earnings over your lifetime? And if something happened to you, how can they indemnify that to replace that? So that death benefit determines the corridor of how much cash you could put in. Unfortunately, a lot of people design policies really poorly. High commission, low cash, so they could take forever. They're with companies that don't really specialize in it. I had first heard, because I use whole life primarily, that was a hole you throw your money into. And as I look at most policies, that's kind of true. But, properly designed with what's known as PUA, paid up additions.
Yep.
So more goes to cash, in relationship to the death benefit you have. You can really get these to perform pretty well, which is a nice place to put business profits. But some people want to put that in pre-tax. The problem with that is there is something called a 412I, which is a qualified plan that you have to buy term insurance on your employees in order to do it. And you have to follow certain guidelines and there's setup fees for it. But it goes in pre-tax, but now it's just like a 401k almost. You have to pull it out and pay taxes on the back end. So I don't love them. I've never recommended them. I've never seen one that I've enjoyed. So don't get too worried about, it's got to be pre-tax, because there's a lot of tax strategies. And if you watch our tax videos, I have that whole tax framework, the 3x3x3x3x3, that once people learn, it's like there's ways to minimize tax. Go in after tax so that you don't pay tax on the back end, where hopefully you're in a higher tax bracket because you have more money in the future.
Yeah,
right.
Definitely.
And
That's
B,
always
you
the goal.
might have less tax deductions because a lot of people, don't own a business when they're retired, or if their kids are at home, it's because they're millennials, not because they're, tax write-offs anymore. So, yeah.
So when someone's going to look into research, start a whole life policy, what are some questions or advice that you have that they can just be considering as they're reviewing the policy, talking to the person that's implementing it, to make sure that they're getting the maximum value out of it?
Cashflowbanking.com is the key, because they're certified cash flow banking specialists. Okay. So you'll see I endorse the site, and really cashflowbanking.com. I own the site and the intellectual property, but I don't own the companies that fulfill on it. They're just people that we've trained and vetted, like people that I've known since 2005, and people I've known even longer than that, but I've been working with since 2008. So they know how to design it properly. We look for mutual companies instead of stock companies. So a mutual company is privately owned by the policyholders. They get the dividends. Stock companies get split between the stockholders and the policyholders. We want multi-billion-dollar companies that have been around for at least 100 years, that have a minimum guaranteed interest rate of at least 4%. That they've always paid dividends, which are above the guarantee since they started. Those are just a few things. That you have flexible PUA, meaning you can put more in or less in, that you're not completely, structured by the very time that you set it up. And those are some of the primary functions, including, obviously A ratings from all the rating services, but those, if you've seen The Big Short, those don't always matter as much as we hope they would.
That movie ruined me when I saw it.
I didn't sleep. Stolba, I was upset.
I watched that on a flight back, I think, on a work trip, and I was looking around like, is anybody else watching this? I was like furious, and the stats that were rolling at the very end of that movie got my blood boiling. It was a fantastic movie, but it ruined me. Movies
on flights always crack me up, because one, if my wife watches comedy on flights, she just laughs out loud. So the flight people can hear. I watch on our honeymoon, I Am Sam on the flight. Have you ever seen that?
That is one
I
of
was
my
bawling my
movies.
eyes out, and I'm like, she's like, are you okay? I'm like, this is a really sad show. Leave me alone. I'm embarrassed.
Oh, it is so sad.
Ooh, yeah.
It is one of my favorites, actually.
Yeah. So anyway, there's three options there. Cashflowbanking.com. If you go to wealthfactory.com/tax, there's some good resources there as well, especially if you're at a higher level. You can go to wealthfactory.com/private if the captive is something that makes sense. We don't recommend them too often. They've been really abusive from a tax shelter standpoint, and they're meant to be a risk management tool. Yeah. And so they get audited a lot, and there's a lot of people that are investing out of the bounds. And so we had a client that was going through an audit. We didn't set the captive up for them, but it was such a nightmare and a bunch of effort. And with my captive, I got a call from the IRS this year, or a letter, you were going to set up a meeting, and they suspended the meetings. I mean, I have everything checked off, so I have zero concern. But it took me 19 years to figure out, yes, this is why you would use the tool and when you would use it. So proceed with caution.
Yeah. It sounds like it might be for a pretty unique situation too. As I read through a lot of questions that have come in on Ask the Money Nerds, there's a common theme that I'm gathering around business savings. Like there's a slight concern of like, why would I just put my money in a business savings account? Because I feel like people they don't feel like they're earning a lot of interest.
Right.
But I guess from my perspective, it doesn't seem harmful to have it sitting in a business savings, at least for a short period of time.
Especially if it's 3 months of your expenses set aside in the business. Just because it gives you staying power, it gives you peace of mind, it gives you, maneuverability. If it's locked away, well, then you could hit cash crunches and put your business in a really distressed situation where you could lose key employees, or you could be chasing, and having the wrong clients just to make, ends meet. And then you're stressed out. You're less creative, because all businesses face cash flow crunches. It's how we prepare for them and how we handle them that make the difference. And when I wasn't prepared for my cash flow crunch in 2008, I took on clients that didn't make sense to work with. They undermined my confidence and the people that worked with me's confidence, and it was very frustrating. And the reality was, we just did it because we didn't have enough liquidity, because I was always running the red line. Reinvest. It's always going to get bigger. It's always going to get better, and nothing's ever going to go wrong. And it hadn't since June of 1998. And then all of a sudden when it did, it was like, I was exhausted. I mean, I was a terrible father and husband during that time. I was disconnected. I was numb. I got all my gray hair for the most part during that time, Stolba. I don't know if I showed you the picture. I was 25 pounds heavier. I looked so different because that's what that level of stress did.
Had a big impact on your health.
Yeah, my health and everything. And I wasn't being creative at that time. I was super stressed. I had a really negative self-talk about like my, it was a really important lesson for me to learn and understand the importance of liquidity. So don't overextend yourself, because you're always trying to get a rate of return. But at the same time, if you had so much money sitting in cash, learn your investor DNA. Where do you want to invest? Is there people you could hire from your business? Do you have, the right processes for your business? Do you have the right technological procedures that allow you to expand? Do you have a compelling enough vision that would require some capital infusion in order to do more, to serve more, to be more impactful? I'm fine sitting in cash value with a lot of my cash. It's just safe. It's secure. I don't have to manage it. It's very much allowing me to work on intellectual property and filming videos and, because I think that it's easy to get addicted to more is better. But the reality is sometimes more is worse, because it's at the cost of health. It's the cost of leisure. It's at the cost of enjoying life along the way. And I had business partners die at age 35. So I know how precious life can be that way. I don't want to just work my life away, but that means I have to say no to certain things that are opportunities. You've seen it with stages people offer, and it's like, this could be good, but it's competing against my health, time with my family, writing, quality of life. So it has to be a hell yes in order to do it, right?
Yes. If it's not a hell yes, it's a hell no.
Well,
right?
It's a no for me, but you're a little bit more intense, I guess. I don't know. Yeah. All right. So look, we've answered the questions here. AskTheMoneyNerds.com. You can continue to ask. I'll even bring on Money Nerds if it's something we want to look at the technical analysis behind it. But we're here. It's just at your fingertips.